Listen up, folks, what a week we just had. Ending on this Friday, June 13th, 2025. It was a roller coaster, a real nail-biter, and if you blinked, you missed it. The big story, the one that had everyone on the edge of their seats, was inflation. We got the numbers, and guess what? They came in cooler than expected. That's right, the price pressures are easing up, giving us a little breathing room. This is the kind of news that should have had the bulls stampeding through Wall Street. But hold your horses, because the Federal Reserve is still playing it cool. Maybe a little too cool for my liking. They see the same data we do, but they're not ready to pop the champagne and start cutting rates. It's a classic standoff. The Consumer Price Index, or CPI report, was the main event. It showed inflation is finally getting back in its cage. This sent a ripple of optimism through the market. Lower inflation means the Fed has a reason, a real tangible reason, to consider lowering interest rates sooner rather than later. And lower rates? That's the rocket fuel for stocks, my friends. It makes borrowing cheaper for companies and makes equities look a lot more attractive than boring old bonds. We also saw jobless claims tick up a bit, another sign that the superheated economy is finally simmering down. That's not bad news, it's good news. It's exactly what the Fed has been trying to engineer with its rate hikes. So, with inflation cooling and the job market softening, you'd think the Fed would be signaling a rate cut, right? Wrong. They held their ground this week, keeping rates steady and pushing their forecast for cuts further down the road. They're telling us maybe one cut this year, maybe. One, that's it. This poured some cold water on the initial rally. It tells me the Fed is still haunted by the ghost of inflation past. They are scared, absolutely terrified, of cutting too soon and letting the inflation genie out of the bottle again. So, we're in a waiting game. The data says cut, but the Fed says wait. It's a battle of wills, and your portfolio is caught in the middle. This created a fascinating dynamic in the US markets. Tech stocks, especially the big-name players in AI, didn't care what the Fed said. They just kept on climbing, reaching for the stars and hitting new all-time highs. These companies are in a world of their own, driven by innovation and massive growth stories that transcend interest rate worries. But other parts of the market, the more cyclical, economically sensitive stuff, felt the chill from the Fed's cautious tone. It's a split market, a house divided. The tech titans are throwing a party while the rest of the neighborhood is still waiting for an invitation. Boom! That's the story of the week. Now let's talk about the Wild West of finance, commodities, and crypto. These markets march to the beat of their own drum, and this week was no exception. Gold, my friends, had a solid week. Why? Because when you have uncertainty about what central banks are going to do next, investors run for safety. Gold is the ultimate safe haven. It's been that way for thousands of years, and it's not changing now. With the Fed being so wishy-washy and geopolitical tensions still simmering in the background, investors decided to buy some insurance. That insurance is spelled GOLD. It's a classic fear trade, and it tells you that despite the stock market rally, there's still a lot of anxiety out there. Oil, on the other hand, had a different story. Crude prices actually strengthened this week. You had solid demand forecasts from major players like OPEC, who are betting on a strong summer travel season. They see planes flying, cars driving, and factories humming. At the same time, we saw US crude inventories fall, which signals that supply is tightening up. It's simple supply and demand, the most basic lesson in economics. Less oil available and more people wanting it means prices go up. This is a delicate balance. If oil gets too expensive, it can act as a tax on the consumer and slow the economy down, which is the last thing we need right now. Then we have the crypto-verse. What a mess. Bitcoin and its brethren took it on the chin this week, big time. The reason is simple: higher for longer. The Fed's message that it's not in a rush to cut interest rates was like kryptonite for crypto. These digital assets thrive when money is cheap and investors are willing to take risks. When the Fed keeps rates high, safe government bonds start looking pretty good, and investors get shy about speculating on volatile assets like Bitcoin. Money flowed out of crypto funds as traders decided to take their risk off the table. It's a classic risk-off move, plain and simple. So you see the contrast here. Gold, the ancient store of value, shines when there's fear. Oil moves on fundamental supply and demand, and crypto? It got knocked down because it's still seen as the ultimate speculative play, highly sensitive to what the Federal Reserve does or doesn't do. There was no hiding place for the crypto bulls this week. The Fed's cautious stance was a bucket of ice-cold water thrown right on the digital campfire. It's a stark reminder that even in the new world of digital finance, The old rules set by central bankers still call the shots. Don't you ever forget that. Let's take a trip around the globe because it wasn't just an American story this week. Over in Europe, they're singing a different tune. The European Central Bank, or ECB, already pulled the trigger, cutting interest rates last week. That's a huge deal. They decided their inflation problem was under control enough to start stimulating their economy. This sent a wave of optimism through European stock markets. The StoxX 600 index, which tracks the biggest companies in Europe, had a fantastic week, hitting record highs. Investors over there are celebrating the idea that the worst is behind them, and that their central bank is on their side, ready to support growth. Now let's hop over to Asia. It was a mixed bag, a real grab bag of different outcomes. In Japan, the market was on pins and needles waiting for the Bank of Japan. There was a lot of chatter that they might start tapering their bond buying program, which would be a major step toward tightening policy. This uncertainty kept a lid on the Nikkei index. Meanwhile, Chinese markets were sluggish. They're still battling their own economic demons, from a shaky property sector to weak consumer confidence. The stimulus measures from Beijing haven't been the magic bullet everyone hoped for, so investors remain cautious. It's a reminder that Asia is not one single market. It's a collection of unique economies with their own challenges. Down in the Middle East, markets were mostly reacting to the moves in the oil market. When crude prices go up, as they did this week, it's great news for the economies of Saudi Arabia, the UAE, and their neighbors. Higher oil revenue means more government spending, more investment, and a healthier economic outlook. Their stock markets, like the Tadawul in Saudi Arabia, saw positive momentum. These markets are directly tied to the fate of energy prices, and this week, that link worked in their favor. They are riding the wave of stronger demand forecasts and a tighter global supply picture. Bond markets around the world were also telling an important story. U.S. Treasury yields fell sharply after that cool inflation report. Remember, bond prices and yields move in opposite directions, so falling yields mean bond prices went up as investors bet on future Fed cuts. In Europe, German bond yields also dipped as the ECB's rate cut, and the soft U.S. inflation data fueled a rally in government debt. In emerging markets, it was a bit more complicated. While the prospect of lower U.S. rates is good for them, the cautious tone from the Fed kept a lid on any major rally. They need the Fed to actually start cutting to really take off. So, what's the bottom line after a week like this? What's the big takeaway for you, the individual investor? It's this: we are at a major turning point. The data, especially that cool inflation report, is screaming that the economic fever has broken. This is fundamentally good news. It paves the way for central banks to shift from fighting inflation to supporting growth. The European Central Bank has already started down that path. The question, the billion-dollar question, is when the U.S. Federal Reserve will join the party. Their hesitation is the single biggest source of uncertainty in the market right now. You have to understand the cross-currents. On one side, you have powerful disinflationary trends and the promise of lower rates, which is pure adrenaline for the stock market. This is why tech stocks are flying high. They see the future, and it's a future with cheaper money. On the other side, you have a Federal Reserve that is acting like a hawk, scarred by the inflation of the last few years and unwilling to declare victory just yet. This tug-of-war between the positive data and the cautious Fed is defining the entire investment landscape. It's creating a split market where certain sectors thrive while others languish. Geopolitics is the wild card you can never ignore. Tensions are still simmering around the world, and that's why gold had a good week. It's the market's fear gauge. And the price of oil is a constant reminder of how global supply chains and political stability can impact your wallet. These factors are always lurking in the background, ready to disrupt the neat narratives of economists and central bankers. You have to be diversified, you have to own quality, you have to be ready for anything, because the world is a messy place, and the market reflects that messiness every single day. My final thought is this: don't fight the Fed, but don't ignore the data either. The data is telling you that things are getting better. The Fed is telling you to be patient. So what do? You stick with high-quality companies with strong balance sheets and real earnings, especially those that benefit from unstoppable trends like artificial intelligence. You don't try to guess the exact timing of the next rate cut. Instead, you position yourself in the winners that can power through this period of uncertainty. The road ahead might be bumpy, but the direction is becoming clearer. Now go do your homework.